Dividend investors, bonjour, Mike Hiro here, founder of Dividend Stocks Rocks and passionate investor. Today, I'm looking at 5 undervalued dividend stocks, all on the US market, because last week I did a very popular video, so thank you for following me on this one, about my favorite 5 Canadian undervalued stocks. So we continue today with those companies that are getting hit on the market for maybe no reason, maybe there's a risk, and this is the point I want to bring here before we go into my top 5. Keep in mind that when a company is trading at a lower P ratio compared to the market or compared to its industry, there may be some risk attached as well. After all, I remember that BlackBerry used to trade around a P ratio of 4, and I don't think it was a good deal, right? It was because it was being eaten alive by Apple back then. The company had no debt, they had billions of dollars in their bank account, and yet nobody was giving any value to the stock. Well, it depends. It appears that the market was actually right, and there was a problem with the stock, so you have to consider this whenever you look at a company that is trading at a low price earnings ratio, and I'm going to disclose those risks in this video about my top 5. So before we start, just a small disclaimer, this is not buy sell recommendation. I am not your advisor, I'm not your broker. So if you're losing money on picking any of those stocks, I am not responsible for your loss. But on the good side of things, if you're making money, you don't have to pay me a dime. All right, so we're going to start with Viacom. Viacom has been in the news lately because it was part of a huge crash from a hedge fund. Long story short, a company had multiple interest in Viacom, used leverage, they got hit by margin calls, and they got stuck to sell a bunch of stocks. Then the stock price dropped by more than 50%, and now here we go. We have either a buy opportunity or either a stock that is going to die in the ditch. I will vote for the opportunity. I actually bought some Viacom myself. It's not typically a trade that I would do. If you look at the graph, especially in terms of dividend growth, we only have like 2 increases over the past 5 years. That does not meet my investing criteria. So this is why it's not a long-term investment for me. It's part of some speculative plays. I like to get like maximum 10%, but usually I keep it around 5-6% of my total assets, total portfolio, to be in such speculative plays. So Viacom has been on my radar for that reason, mostly because the stock price kind of dropped for no reason attached to the company. Yes, they issued shares, but when you keep in mind that last year in 2020, management was buying back shares, and when they saw that the stock price surged, they decided to issue more shares at a higher price. So it was kind of like very clever, very good way to actually get more cash flow for their operation. And when you look at its P ratio, we're talking about a company that has currently trading at like 10-11 times their earnings. Forward P ratio is along the same thing. Obviously, you cannot look at 2017-2018 P ratio. It went like at 180. This is maybe one of the flaws when you look at P ratio. It's based on accounting rules for earnings per shares, obviously, and sometimes we don't get exactly the right picture, but what you can see over a longer period of time is the company usually trades at a higher earnings multiplier, and this is clearly an invitation for a little bit more investigation. So looking at their business model, Viacom is a content and entertainment business. 40% of their revenue in 2020 came from TV entertainment. I'm pretty sure that you're all very familiar with CBS. 50% came from their cable networks. They have a bunch of great TV channels like Showtime's, Pluto's that is going on streaming, Nickelodeon, not very easy for me as I speak French to say, MTV Network. So a lot of like great channels. Obviously, it is also a flaw because a lot of people are cutting down cable, so they need need to move forward with streaming services, and they need to find other ways to grow their business. And they also have, through Paramount, 10% of the revenue generated by the movie business. Obviously, this company relies a lot on fees that people pays for cable and also from advertisement revenue. 2020 was obviously a more difficult year because of the pandemic, and then the film industry was not doing very well. But moving forward, they do have a very good growth vector, which is called streaming services. To be honest, my favorite streaming service is definitely Disney. They are a lot more well established, and they grow a lot faster. They're bigger. They spend more money into content, and they have this knack to use characters and stories and multiply that into so many different streams of income. It's just beautiful. Viacom goes into this war zone. There's a lot of players. AT&T with HBO Max is there. Netflix is not ready to leave the throne either. So you have several players. It's going to be tough. But on the other side, Viacom has been producing content for a long time. They know how to create TV shows and series, and I'm not too worried about this part. One of the reasons why I decided to buy the company right now, to buy shares, is actually its ability to generate cash flow. When you compare it to the free cash flow of the company versus the dividend paid, you can see that right now on a yearly basis, the company pays about $600 million in dividend, but they're generating about $2 billion in free cash flow. So this tells me that they have enough money to pay their dividend, to invest in content, and to boost their streaming service platform. This is what you like when you do a speculative play. In the meantime, I'm not worried about the dividend payment. I'm pretty sure that once we get a few quarters in and then results are good, then we should have a stock price slightly going up. And hopefully at one point people will realize, oh, well, this whole story was about an hedge fund, and this company is clearly a victim in this story. This is my bet. It's up to you if you want to follow it or not, but I think it's a good way to put a few dollars in and see what happens. Next on my list, AbbVie. AbbVie, healthcare business, going up, going down. A lot of drama around Humira, one of its most popular drug. Obviously, 40% of its revenues coming from that drug, even more in earnings because it's a high margin drug. Patents are expiring all over the world and in the US, so we fear that revenue is going to decrease, especially profitability as well. So there's a lot of worries about this company. As you can see though, is revenue are going up. They have made a key acquisition of Allergen, which owns Botox 2 years ago, which actually will probably propel the company to another level. They are known for having this incredible law department where they can design ways to avoid patent expiry, find new tricks. Actually, Botox is a trademark. It doesn't even have a patent, so you can see that it could be very useful for AbbVie to play around those rules. And in terms of dividend growth, we have something that goes very well over the past 5 years. In terms of PE, you're going to tell me, Mike, what are you doing? The PE ratio is at like 39. This is completely ridiculous. But when you look at the forward PE ratio, we are at 9. So there's a big difference here. And sometimes you have to look at what happens here and what you can see clearly between 2020 and 2021. There's a huge gap in terms of PE ratio. This is obviously caused by accounting rules. So you always have to dig deeper. When I look at a graph like this and it goes up and down and up and down, what I usually do is I look at quarterly earnings statement, I look for the explanation, and then I try to understand what's happening here. In this case, the forward PE ratio tells me a different story. Company's doing well, and actually what I like about AbbVie is that they're well diversified. They have lots of pipelines around the immunology and cancer drugs, and this is where you can hope that AbbVie will develop new drugs, develop new patents, and kind of like replace Humira downfall that will eventually happen. When you look at neuroscience and allergen as aesthetic, we have like obviously Botox that is well present here, but the future of the business will continue to rely on their ability to develop their pipelines, and they need a lot of cash flow to invest in R&D. So you have to keep that in mind. This is definitely a risk. What's going to happen once Humira sales started to heavily decline and then profit will fall? They need new drugs to replace it. There may be a gap, maybe a tough couple of years in between, and this is probably why AbbVie is offering such a generous yield. In the meantime, you get paid to wait. When you look at the cash payout ratio, so the cash flow used to pay dividend, we have something around 50% while the dividend keeps increasing all the time. For me, it's a very important sign from management. I am no scientist, so it's very hard for a retail investor to determine if a company can develop new drugs. And you can read about the different stages, and you can read about the pipelines, and you can get very excited about it, but just between you and me, we don't know much about it, right? One thing I can track that will show me the confidence of management in their business is how they increase their dividend. From a management perspective, they know that each time they increase their payouts, they must live with that hype, and moving forward, they will still have to pay for that dividend. And when I look at a company that maintains a cash payout ratio around 50% and keeps increasing its dividend year after year, this gives me a lot of trust, a lot of confidence in this kind of business model. Moving on to another quite interesting company, Intel, classic old tech stocks that pays a dividend. A lot of people loves it. A lot of people know it because if you have a PC at home, chances are you have Intel inside, right? When you look at the dividend triangle, relatively positive revenue and earnings growth are pretty steady. We have good dividend growth perspective here as well. And one of the things that they found at Intel is they were able to benefit from their knowledge in the chip business and build data centers. And we'll get there in a moment. First, let's look at the PE ratio. PE ratio is like very low for tech stocks. We keep talking about, oh, the tech industry is like going crazy right now. It's a tech bubble. We have like Microsoft and Apple trading over like 30 PE ratio right now, and then you look at Intel and you're below 14. You're actually below 13, sorry. So on the graph, you're at like 12.93 for the current PE ratio, and forward is pretty much along the line. So what it tells us is there's probably a problem. There's probably a growth problem somewhere. So let's dig a little bit deeper and try to understand what's the problem with Intel. First, let's take a look at their business model. Obviously, it's I would say I would qualify it like between like 50% of their business is related to the good old PC. Latest results were good in that sense because they sold a lot of notebooks. Obviously, laptops are trendy right now. People are working from home. They need to like move a little bit from time to time, so it's a lot easier to work on with a laptop than a desktop. Personally, I still prefer the desktop, but that's another story. And the other part of the business, it's all about Internet of Things, automotive, artificial intelligence, and data center. So that's like pretty much 50% PC, 50% of the rest. They have incredibly well done in terms of data center. They are working on chips, but the problem here is the ability of Intel to develop new chips and keep up with competition. Competition is incredibly fierce in that environment. We're talking about AMD, NVIDIA. A lot of chips development is being stalled right now, and Intel had like some problems developing their chips at the expected rate. They kind of like disappointed the market a lot in 2020 for that reason. Now, a lot of investors are afraid that Intel will lose some market shares, and then you'll see NVIDIA, AMD of this world to be a little bit faster in terms of developing those chips and then getting those market shares. And this creates some discomfort among investors. So on one side, Intel has always been able to invest in R&D and keep its edge against many competitors. They have done well in the past. They always found a way to grow and make it happen. But on the other side, they also fell incredibly with smartphones. They were not able to enter chips in this industry, and this is a big concern for me when I look at tech stocks. I like Intel, but it's not my favorite one for that reason, and I don't have it in my portfolio also for that reason. So be careful about that. Technology evolves very fast, so either Intel will be able to continue with data center, artificial intelligence, and automotive, but if they fail and they cannot keep up with their technology edge, then other will take their place, and it will be a very rough couple of years. So the story needs to continue now. Moving on to another sector completely. Now we're in the food business with Tyson Foods. Tyson Food has been on a rocky road. When you look at the price, it goes up, it goes down. There's some worries. Sometimes it goes well. They have large market shares in protein. Revenue is relatively going up. They had some problems with earnings, so it's not always as profitable as they thought. And obviously now they have to put a lot of investment into protecting their employees in their meat plants, and this will obviously affect margin. In terms of dividend growth, you can see it's slowing down for the past couple of years. This is an indication that you have to be a little bit more like not concerned, but go a little bit deeper and follow them quarter to quarter to make sure that the company is doing well. But since there's dividend growth, it's not that bad. In terms of valuation, another classic story. We have a company trading around 13 P ratio, both current and forward. So very stable company, great business, food, quite defensive at the same time. So you can think, well, the company will continue to sell food, right? And as people are looking for more protein in their meals, well, technically they should be able to do well. When you look at their business model, we're talking about a company that has beef, pork, and chicken. They also sell a little bit in the international part. They must put more emphasis into international sales. I think this is where the growth vector will be in the future. We have 50% of their business around retail, so people that are going to their groceries, buying like prepared foods or frozen food or directly like meat. So this is recurrent revenue, but you also have like 28% in food service. You have to be a little bit careful about this part of the business. Restaurant and other food services will have a hard time with the pandemic, how long it will take to have like those restaurants fully open across the world. This could take some time, and this could be something that you can worry about right now. When you look at their market share, though, they are incredibly strong. Regardless if it's about beef, about pork, about chicken, they are dominating the market. And this is one of the reasons I would be patient with a company like Tyson Foods, especially if the company continues to increase its dividend. It was on and off in our portfolios at DSR for that reason, so we were able to capture the growth out once in a while. Right now, there's some price momentum as well attached to it. So another stock to be added on your watch list right now. Now, before I move to actually my favorite pick of the pack, just want to tell you that if you've enjoyed this video, please subscribe, please follow me. Actually, the reason why I'm doing those videos is I want to grow this channel, I want to help many people, and the more you interact with me, like tell me about your favorite stocks, tell me about questions about you would like me to do on other videos. This helps me help more investors grow the channel and everybody benefit from it. So please subscribe. And then now moving on to my favorite one, Lockheed Martin. I've been a shareholder of Lockheed Martin since 2013 or 2014, so it's been a while. Very happy shareholders, obviously. When you look at the graph right here, the dividend triangle is almost perfect. So we have a company that is growing its revenues, growing its earnings, and obviously growing its dividend. However, stock price is going sideways right now. When you look at their P ratio, we're talking about a company trading at a 15 P ratio. That's pretty low. That's very low considering the size and the potential of the company, and there's still growth. You know, funny fact, we may think, oh, all the business, all the government in the world are getting like squeezed by their budget, and it's going to be very hard for them to spend more money in military and defense. But funny thing is, in 2020, military spending actually increased. It didn't decrease, it increased by actually like 4% from what I read recently. So this is a good sign for Lockheed Martin. Another good thing is they already went through a budget sequester back in 2012. All military and defense company went through getting a lot leaner, cutting down on the fat, making their profit margin better. And while revenue were not growing, earnings were still increasing year after year, which is a very good sign of strong management. When you look at their business model, well, when you think Lockheed Martin, you think about their F-35. And let's be honest, nobody else is able to make those those jets, right? They have a huge contract with the US government. Last year, 74% of all revenue came from the US government, not just for aeronautics, but for the entire business. So their fate is tied to US government budget, and this is no joke. You have to be careful with that's for sure. And this is probably one of the reasons why the company is going sideways these days. But they also had other revenue streams. So we have space that are doing like satellites, tactical defense, and then defense system as well. RMS stands for Rotary and Mission Systems. Now we're talking about ships. We're talking about helicopters, and then other services for military forces. We also have MFC, that stands for Missile and Fire Control. That's pretty much explain it all. So the company is well diversified. They're well known. It is a sticky business also because they have long-term contract. You can look at their backlogs to have a good impression if the company is doing well or not. So even if budget moving forwards are stagnant or getting cut a little bit, they still have lots of backlogs that will also provide some great cash flow moving forward. Over the past few years, they also had the permission to explore a little bit on the international market, trying to diversify their business and not only have the US government as a client. Obviously, at 74% of all sales coming from the US military, you can imagine that they're not that diversified yet, but this could be quite interesting for the future to expand their horizon with other countries. There's limit there, obviously. I'm not expecting the company to show 50% of their revenue coming from international markets in 5 years from now, but it could help to have like to play on both sides of the world. So we'll see how it goes. I'm going to finish this video with one of my favorite graphs, which is the relation between the number of outstanding shares and the dividend growth. What you see here is over the past 10 years, Lockheed Martin has systematically buying back shares year after year, so making like their stock price a little bit more resistant to recession and generating value to shareholders. What I like about that is they also almost tripled their dividend payment over the past 10 years. So we're talking about 247% increase of dividend in 10 years. That is incredible. And you know, when you think about it, the more shares that you buy back, the easiest it is to pay dividend because your dividend bill decrease along with because you have less shares to pay on. Lockheed Martin is very shareholder friendly stock. It is the type of company that you can buy and sleep on it very well. Well, this is what I do actually. It's been now 7-8 years that I have in my portfolio. Very happy about it. So hopefully that you have enjoyed this video. I would now like you to go in the comment section and tell me about your favorite undervalued stocks. Is there any company that I've missed? Is there any company that you found recently that is on your radar and you would like me to analyze? Let me know in the comment. It will be my pleasure to review them. And until the next video, stay invested.